this screen make my face look red? I think it does. I've seen the preview, don't worry. Today we're going to be talking about my favorite dividend ETFs. Obviously some people might disagree with some of these selections. Overall, just counted for you. 1, 2, 3, 4, 5, 6 of them listed today. Not necessarily all ones that I hold in my portfolios. Some that I just as kind of like. There's a couple different strategies, and I'll mention you with each one. Some are more focused on entirely focused on equity. Some are focused on a mix of equity as well as market gains. So keep that into consideration as far as that's concerned. So we'll go over the yields of these companies or these ETFs. As well as historical performance. We're going to start with the cream of the crop. I think it's very much worth mentioning. I think we know what the cream of the crop is here. It is the SCHD, the Charles Schwab U.S. Dividend Equity ETF. Why is this the cream of the crop? Well, you see performance on the stock has been historically pretty significant. The past 5 years, 81.93% growth in the last 5 years. So it's great since inception. Great stuff. This has grown up 199% since inception in 2011. So the progress here in terms of the stock price has been significant, right? Capital gains have been nice. It's hard to see market gain as well as a nice yield. And let's talk about a little bit about this fund. So for all of these, you can easily access all this information on their website, whoever the fund is by. So this one's by Charles Schwab, obviously. You can see an expense ratio very low of 0.06. It's incredibly low for an expense ratio. It's what I really like in an ETF, all things considered, because that helps you keep that stock price from going in the wrong direction. The higher the expense ratio, typically it'll get paid out through the stock price, unfortunately. So keep that into consideration as well. Some of the details of the fund. Well, what kind of good stuff do we got? Obviously, inception was 2011. You see here, October 20th. Pretty nice to see. Nice expense ratio, pretty darn low, in my perspective at least. Very low. So this is a passively managed fund. So you have to consider that. Distribution yield here, as of the most recent dividend here, was 2.87%. So not necessarily one that yields the highest, let's say, but when I'm talking about dividend ETFs, for the sake of this video, I'll be looking solely at ones that are yielding right around 3 or above. So I'm looking for high yields here. So there are higher quality ETFs than the ones I'm going to list, but this right here is a very good mix of both equity as well as market gain. So it's one I really like. If you look at some of the holdings on this one, it's companies you know. Pfizer, Home Depot, just the top 10 holdings here. Broadcom, Cisco, PepsiCo, BlackRock, Texas Instruments, Coca-Cola, Merck, Verizon. You know these companies, right? And these make up actually a very good portion of this entire fund. These are very quality companies that pay a good, consistent yield. So that is where this company is able to consistently pay a nice dividend. If you look obviously historically in terms of the dividend, performance has been great. Again, you see the yield there. 13% 5-year growth rate of the dividend is nice. But again, if you look in terms of historical amounts, you see variable. That's the thing you get with ETFs. It is variable because it's based off of what was paid to the fund itself, as well as, in some cases, how much money the fund made, how they're able to pay it out. So again, overall, there's good growth here consistently. It's a nice fund. So that's SCHD for you. My next one here is going to be a little bit more equity focused. It's going to be JEPI, one I've talked about before. It's a JP Morgan Equity Premium Income ETF, one that was not accessible to you and I before too long, or before really a couple of years ago. So this was a fund that was exclusive, at least a different version of it was exclusive solely to those with a minimum buy-in of right around, I believe it was $1 million minimum buy-in, which you and I, we don't have that money to invest. But we do have, when you bring it to the general market, we've got money to invest in it now. You look at the performance of this one last year at 14.77, and on a 5-year basis, which isn't really fair because, again, this is a 2020 banger right here. So this is really just slightly over a year's performance at 22.5%. Looking like some very, very nice performance, all things considered, in terms of market gain. So keep that in consideration. Let's look a little bit into the fund. You see overall the net expense ratio on this one is only 0.35, which is a little bit different, right? This is an actively managed fund that's focused more on a covered call strategy. So if you didn't know on covered calls, you look here at the top holdings. These right here are covered calls. So basically they're, as you would with trading options, they're making bets on certain stocks. Typically it's going to be S&P 500, just generic ones too, and based off of the equity that they get off of those trades and those call options, that's what they're paying out in terms of the dividend yield. So you're getting paid more based off of the performance of the fund, all things considered. You see the 30-day yield on this one here of 7.08%. Very nice yield on this one. And again, it is you have to consider it's based off of the performance of these call options. Otherwise, in terms of stocks they hold, they do hold some common stock as well. Normal funds, or normal, really just equity here in Accenture, Intuit, Microsoft, ET, Alphabet. So they have basic companies here too, but again, it's actively managed, focused more on really spending that income that they receive back into the shareholders in terms of dividends as well. If you look into the dividends category, again, very much variable payments that stay relatively stagnant, all things considered. So some quarters they get more than the others, just entirely based off of the performance of what they're able to do. So keep that into consideration when you look at this one. It's overall one that I really like, actually. It's a pretty darn nice ETF in my opinion. So that would be JEPI for you. Next we have SPYD, the Spider Portfolio S&P 500 High Dividend ETF. One I like quite a bit, actually. 1 year performance on this one, 38% up, is pretty significant, but on a 5-year basis they are only up 18.96%, mostly because of the companies that are held within it. If you look at some of the holdings on this bad boy, you see overall companies like Baker Hughes, Huntington Bancshares, Pfizer, Amcor, Entergy Corporation, Comerica, Iron Mountain, one that I talked about quite a bit, Exelon, Franklin Resources, and Marathon Petroleum. Again, these are definitely some good stocks here. Mostly they're copying the index for the most part. So all things considered, they're mostly copying just the S&P 500, but they're focused a little bit more on some of the higher paying companies in terms of dividends. So keep that into consideration. If you look at really overall what the stock offers, gross expense ratio of only 0.07 is pretty darn nice in my opinion. So one that I certainly like. If you look at the yield, let's see, we can find the yield here real quick. Don't you worry, they're hiding it from me. 30-day yield here of 4.03%. So the yield's pretty significant here, all things considered, and it offers you some capital appreciation as well. So that's why I like the fund. It's pretty nice. I don't think this thing wants to work here, but we'll get it to work. If you look overall, obviously dividend history, this is giving it a trailing 12-month yield here of 4.83%. with a 25% 5-year growth rate is pretty significant. Again, you look at history, and it's going to be variable with this one. Again, it's mostly based off of what they're paid out to them as far as what they can distribute. So not a shocker here. Q4s tend to be typically pretty big for them in terms of dividend payments. So very nice. So let's get into my next one, which is going to be a little bit more risky. My next three are a little bit more on the risky side. And you can definitely tell that for sure. So next one's going to be KBWY here. KBWY is the Invesco KBW Premium Yield Equity REIT ETF. Yes, this is a REIT-focused ETF, which you know obviously historically has good yields, right? REITs typically do. 1 year performance here of 29% is really just a great recovery from the year prior. But again, if you look on a 5-year basis, this is one that's down 33% in terms of overall performance. Was trading pretty consistent, all things considered, prior to 2020, and that kind of mashed it just a little bit. At these levels, I like it quite a decent bid, actually, because I think it's actually closer to fair value than it was. And this is one that I'm more focused on income than I am necessarily capital gain. And you can see that for a couple different reasons. We see a 30-day yield here of 5.41%, which is nice. 5.41% yield it's a beautiful dividend yield, all things considered. This is also a company that pays, or an ETF that pays monthly dividends. So if you're in the monthly dividend game, this is one that's pretty decent, all things considered. Now, the overall, if you look, the expense ratio, not terrible at 0.35. So for a 0.35 yield, for a fund yielding 5%, 5.5%, I feel pretty decent about that, all things considered. If you look at some of the stocks that are held within it, mostly small cap here, as you can see, it's containing small cap stocks, and that's where you've seen a little bit more of a beat down as opposed to some of the other companies out there. So small cap, you might not necessarily know some of these. Preferred Apartment Communities, American Finance Trust, City Office, Blue Rock Residential, Global Net Lease, Unity Group, and Office Properties. Again, you might not know these. Sabra, you might know them. Gladstone. So quality companies still in here from a small cap basis. So one I like. Yeah, so keep that in mind. It's an Invesco fund. Next, we have another Invesco fund with KBWD, one that I've held for quite a while as well. This one's more focused on the financial industry. So 1 year performance here has been up really right around 48%, is very significant, but in the past 5 years actually is down 5.48%. Again, this is because financial institutions have seen a very good recovery since the 2020 dip, but not quite back to where they were, so that's part of the reason for this. If you look at some of the overview here, 30-day yield here of 7.62% is quite significant, but you have to consider this is one that absolutely has a much larger expense ratio. So overall net expense ratio here of 1.24% is pretty darn high. That's because really just this acquired fund fees and expenses as opposed to the management fees. So as a more actively managed fund, it's going to be a higher yield, which is this is a pretty high ratio, all things considered. It's a pretty high expense ratio. It's my main thing I don't like about it, but it's also a monthly dividend payer, and the yield is pretty significant when you're talking about 7.6% yield. So overall, I think it's one that I'm pretty okay with, and really over the past year has been pretty significantly in terms of good performance. So next we have QYLD. Now this is one that kind of has a cult following. This is also another covered call strategy ETF. This is one that's been performing all right over the last 5 years. Really, one year performance of only 5.7% up, clearly trailing the overall market, but the yield's quite significant and up 4% over the past 5 years. Pretty insignificant as well. Again, because this isn't necessarily one you look for capital gains on, in my opinion. This is one that's entirely focused on overall yield. So some of the fine details on this one, again, is it's a covered call strategy. The portfolio is not necessarily there. It's more focused on covered calls. Incepted in 2013. Overall expense ratio is 0.6, which is not that crazy high for a covered call ETF. And a trailing 12-month yield of 12% is pretty nice. But really, when you look on a 30-day SEC basis, don't look at that. That's some nonsense. But the yield is right around 10% here, all things considered. So very much focused on income as opposed to overall market gain. So that's what I like about this one more. It's pretty nice. I mean, all things considered, I like it. A decent bid in that aspect. Top holdings here, quite a bit of money into Apple here, Microsoft, Amazon, Alphabet, Facebook, Tesla, Nvidia, Alphabet, PayPal, Adobe. These are very higher risk tech companies. Again, these aren't paying you dividends. That's the thing. these aren't companies that pay dividends for the most part, besides very small ones. Apple, Microsoft pay a sub 1% yield. Nvidia pays tiny 0.5% yield, maybe even less than that as of late. But the reason they're getting this high of a yield of 10% is because of the covered call strategy. So the money they're making off of these calls is based off this performance, and based off of that is how they pay out to you in terms of your yield. So this pays a very nice yield on it, but it's a lot higher risk. And again, I think you can see that in the stock performance. You see a lot of up and down movements here. And again, some people might not have the stomach for this. But if you're in for the long haul, this could be one that proves decent in terms of yield for you. So keep that in consideration. If you're looking for equity, monthly dividends, might be a decent one for you. That's what I got for you today, and I hope you have a great one.